Today, on the bottom line, the market has flipped upside down and inside out in September. Portfolio manager Sarah Hunt likes energy stocks, and CIOs tell us what keeps them up at night. Hello, welcome to The Bottom Line presented by Fidelity Investments. I'm Sara Silverstein at the NASDAQ market site in Times Square. This week's bottom line is the resilient bull market. September, we've seen everything flip upside down and inside out in the markets. If you look at the S&P 500, as Joe Cioli of Business Insider did, and you break it down by bucket of quintile, and you look at the worst performing stocks from January through August, which were down on average about 20%, those stocks are up 5% so far in September. And if you look at the highest performing 20%, they were up about 40%, and now they're slightly down. But what's even more interesting is that Joe breaks it out by sector. So in this chart, you can see that he ranks the sectors by the best performing from January to August to the worst performing. So it's led by tech, which was up 25% through August, and now is down slightly. So you can see in red, we overlay how these stocks are doing in September. And you can see energy, which was the worst performer through August, is now the best performer this month. And telecom has completely switched sides as well. This is interesting because we've been pinning this real consistent surge of the stock market on the leaders of it, the tech stocks. But it has continued even without the tech stocks leading it. And even 8.5 years into the bull market, it seems like every time the market loses a key driver, another stock is there to step up and take its place. And that's the bottom line. Business Insider's finance editor Matt Turner went to the UBS CIO Global Forum this week, and he talked to CIOs about what their biggest fears were. Here's what they had to say.
We've talked a lot about the opportunities in markets. Where are there the risks? What is it that's keeping you up at night and that has you worried?
I think one of the things that always keeps me up at night is the risk of a policy mistake. I tell people, look, every time I checked, every one of the central banks around the world, the pencils come equipped with erasers at the top. There's no infallibility. Vatican City is the only place that claims infallibility. Central bankers do not have that, nor do they claim it. And we have to also understand we're living through what has been the greatest monetary policy experiment in history. We've never seen this before. I grew up in an environment where early in my career as a fixed income strategist, and I always led to believe that zero interest rates were a lower bound. Well, apparently that's been put on its head because apparently rates can go below zero. So we've had a change in the rate dynamic, but we've also seen a much different approach in terms of how central banks are willing to expend and expand their balance sheets. Think about the Federal Reserve, the Bank of England, the European Central Bank, the Bank of Japan. What they've all engaged in is this extraordinary balance sheet expansion that commonly has been known as quantitative easing. So that's been extraordinary in terms of helping stabilize markets and allow the economy to recover. But now we're in the process of the beginning, the very early stage of process of policy normalization. And that's going to be a bit of a challenge because we haven't been here before, so there is no rule book, there's no guidepost to how we do this. So I think what's going to require is very prudent actions by central bankers. They're going to have to be cautious in terms of how they apply policy changes. They have to be very transparent and open with markets about what they intend to do and what they are doing. So I'd say if you ask me what the biggest concern I have is, it's for a policy misstep map. It's that somewhere along the line central bankers they get it wrong. Either they move too quickly or they move too slowly.
Yeah, so I'd say a few different things. I'll take a couple different directions. One, of course, there is the possibility that in the unwind of QE, something huge happens. I think that that's more likely to stem from another region of the globe outside the U.S. Not huge likelihood, but it worries me. Second, the U.S. politics, and I don't want to get too deeply into that area, but it's definitely volatile, and we're seeing some political dynamics we haven't seen before. The U.S. does have a pretty robust system of checks and balances, so our core guess is that will be okay, but there's certainly a bit more risk. Third thing would be some sort of, and I hate to say this, some sort of terrorist incident. Again, not something I think is overly likely, but it is a worry. My biggest worry actually in terms of probability is the least exciting or interesting one, which is just the natural aging of the cycle. The reality is unemployment has come down a lot. Participation rate has gone up. We've started to burn through some of the slack in the labor economy. When that starts to happen, you start to see wages coming up. And though you haven't seen that as much in the headline numbers, you've seen it a bit in some of the second order numbers underneath that. With that, you tend to get rising rates. You eventually start to get investor over-optimism, management over-optimism, and the classic end of a cycle. We think that's the most likely thing to happen. We don't think it's started yet, but to use the classic baseball analogy, we think we're probably in the 7th inning.
Certainly what happens with interest rates and inflation is number one. I think that there are other things like the North Korea situation, which I think day to day, it's something that hits the headlines and may move markets over the short term, but then the market kind of reprices and normalizes these things out. But I do think there's something a little bit different about this North Korea crisis, because we are reaching a point where this nation, North Korea, may be able to send missiles to the United States, and that hasn't been resolved yet with the American people. So I think there will be another stage to this. Again, it doesn't have to be a market event, and it doesn't have to be resolved in what was recently called an ugly way, but it will need to be resolved or accepted at some point in the future.
I'm here with Business Insider's finance editor, Matt Turner, who just came back from his wedding celebration.
I did, thank you.
Congratulations.
Thank you very much.
And you also spent this week, you went to the UBS CIO Global Forum for us.
Yes, that's right.
And you spoke to a bunch of CIOs.
Yes.
Thank you. This is a great clip that we have. But also, what else did you learn from them? What other interesting takeaways were there?
So I spoke to about 8 CIOs, big investors, from one individual who managed or oversaw $2 trillion to smaller managers, but again, influential voices in the markets. And I think the takeaway, although they all had slightly different views, was that the stock market, it's fairly valued, it's maybe a little bit richly valued, but not too much. So everyone felt like there was a certain amount of overconfidence maybe, that the valuations were a little bit stretched, but they didn't see any causes for alarm anytime soon.
So everybody still feels like, yeah, valuations are high, but no necessary catalyst or cause for a correction?
Exactly. No cause for correction. Harder to find opportunities maybe, so you have to work a little bit harder to find those segments of the market where there's still money to be made. But there wasn't anyone that I met or spoke to that said, you know, we're going to see a 5 or 10% drop anytime soon. Still just edging higher, grinding higher.
Which is interesting, which leads us right into our Fidelity Insight today. Fidelity's Director of Global Asset Allocation Research, Lisa Emsbo-Mattingly, says that since 1920s, on average, the U.S. stock market has had about 3 5% corrections a year, 1 10% correction a year, and a 20% correction every 3 years. And if you look at a chart that we have, you can see there's a 20% correction in red, but the rest are 5% corrections in blue. And the most recent one was about a year and a half ago. So there is some concern that we might be overdue for a correction, and Goldman seems to think the same thing. Goldman put out a note, and their bear market risk indicator says there's a 67% chance of a crash, and they're also pointing to the same thing. It's been a year and a half since we've had a 5% correction. So, and as Emsbo-Mattingly also points out that a lot of portfolios, investors have gotten a lot more into stocks recently, where half of their portfolio was in stocks in 2009, 2/3 of their stocks are, 2/3 of their portfolio are in stocks at the end of 2016, which is right where it was before the financial crash. And she's saying you should readjust if that's not where you want to be in case something happens. So one of the things I'm wondering is, do you think that most of that gain in the allocation is from just the increase in the stock prices, or are people actually getting in as the stock market's going up?
So one of the interesting conversations I had was actually with a behavioral finance specialist, and they were talking about this trend for when markets are rich for people to buy and when markets are low for people to sell, which is obviously the opposite of what you should be doing. I think there is a certain amount of, as markets get higher, keep on grinding higher, there's no obvious catalyst for there being a sell-off. People feel like they have to be involved, right? They feel like they're missing out. They see that other people are having opportunities and gains, and they're not. And so that starts to kind of carry a weight for those individuals. So I think you are seeing people put a little bit more money into the stock market. And part of it is also as I said, a lack of a catalyst for a sell-off, right? Whenever we see, I don't know, North Korea or geopolitical risk, markets move a little, but not too much. And so when you see that, you can kind of feel a little bit more secure that if markets are able to shrug that off, then they're going to be able to shrug most things off.
I'm here with Sarah Hunt, portfolio manager at Alpine Funds, which oversees $4 billion. Thank you for joining me.
Thank you for having me.
So you are bullish on energy, and energy's turned around in September. It had a rough start to the year. Is that all oil prices, or is something else at play there?
Well, I think you're starting to see a change in the discussions about oil. So I think that we're getting more constructive on the idea that at some point you're going to see a supply-demand imbalance that's more on the demand side when it's really been on the supply side for the last several years. The conversation is changing, and I think that from a sentiment standpoint, that's very helpful. Of what could happen in the next couple of years in terms of demand finally being there and the supply side being curtailed to some degree. So I think there's still some questions about it, and inventories are starting to come down that could be hurricane related. But I think that you're starting to have conversations that are much more about oil prices starting to stabilize here and maybe being higher in a couple of years than you are about the bottom continuing to be sort of being seen in energy.
And how do you feel about the valuations of energy stocks relative to other sectors or relative to where they were historically?
Well, because oil prices are still fairly low, if you look at them on valuations like PE measures and things like that, it doesn't look like they're optically cheap. But if oil prices continue to stabilize and actually rise, then the cash flows coming out of these are going to start to look better, and then the prices are going to be much more justified than they are potentially at the moment. But that's pretty typical of commodity type stocks, is that they tend to have the valuations look very stretched when commodity prices are cheap. And if commodity prices start to get better, then it starts to look a little less expensive. And we think that now there's much more talk about dividends being sustainable instead of people having to cut their dividends. So all of that, we think that that conversation is changing, and changing in a positive way.
And where is the dividend coming from?
So as oil prices get higher, the cash flows get a little bit better. Their cost side, they've been under big need to cut their costs, and they have cut their costs very dramatically over the last couple of years. Service costs have come down a lot. So for the guys that are producing oil and gas right now, they've gotten the cost side into a much better situation. If the revenue side starts to get better because oil prices are higher, then those cash flows can go and pay the dividends that people were worried about were not sustainable even 12 or 18 months ago, even 6 months ago where oil prices were. So I think if you see a sustained level of oil prices above 50, I think that the conversation shifts to, at some point now, you're going to start talking about the positive aspects of higher oil prices as opposed to worrying so much about their sustainability.
And for the overall market, what do you think about the valuation levels, and is a correction coming?
Well, I think that this is the correction that's been waited for the most of any correction that ever possibly happened. And it's almost like that anticipation makes it makes it possible that it takes longer for it to happen, which certainly has been the case. I think central banks are still expanding their balance sheets, the Fed notwithstanding. I mean, we're supposed to start rolling off balance sheet in October. We'll see how that goes. We'll see how fast that eventually becomes. And the U.S. is raising rates, so arguably the Fed is less accommodative than it was. But actual ease of getting money is easier now than when they started raising rates. So as long as central banks are still expanding balance sheets, I think equity markets can continue to perform because you don't have a lot of other alternatives. You can't go into fixed income because you've got very low rates across the world, and in some cases negative. So I think that equities become that default place where people continue to go. So even though it looks like from a historic standpoint that valuations look a little high, if the economic backdrop is getting better and central banks are continuing to support their balance sheets, then I think that those things can be a driver for equity prices.
And how important is tax reform to the stock market? If it happens, what will happen? What will be most effective?
I think 6 months ago, the idea was if you didn't get tax reform, the market was going to react very badly. And now it seems that the sentiment has shifted to when we get tax reform and we will get something, the market is then going to use that as a positive catalyst. And I think that that's been a sentiment change that's happened over the last 6 months. I think obviously there will be some things that are going to change in the tax code if they can get a bill through. That's going to be positive for equities because if the corporate tax rate comes down, that's going to be a benefit to earnings, which means companies have more cash, which means that they can do more things with that cash. So I think that that is going to be positive for markets. If you don't get it, I think that there will always be the promise that it could come in the next session. Right now it's not like an either or like it seemed like it was with healthcare, which is now it seems like that change is not going to happen. I think that with taxes, even if you don't get it as soon as people want it, they're still going to continue to anticipate it, and so that can be looked at as a potential positive catalyst.
And we've talked to Ray Dalio and Gary Schilling recently, and everybody, and they both say you have to bet against the consensus and be right. Is there something that you see that everybody's wrong about in the consensus, or an opportunity there?
I'm not sure I would phrase it that way. What I would say is one of the other things that we're looking at now are things like consumer staples, which have been beaten up pretty badly. They have decent dividend yields. You know, dividends are important to us. So if you look at places where the market is sort of abandoning and saying, you know, there's a structural change here in the way food's going to be delivered, and Amazon is changing supermarkets, and therefore the food companies are going to be under pressure, that all may be true, but they're getting to valuation levels that now start to look attractive, whereas, you know, a year or two ago they were sitting at very high multiples with very little growth. And so I think it's more about shifting within the marketplace as opposed to saying, you know, looking for a full correction of the entire market, but looking at places where investors are sort of ignoring things, which is more on the value side because they've been chasing growth.
And is there a consumer staple that you particularly like?
We're looking at Smucker's right now, which has come down quite dramatically and is now trading at about 13 times next year's earnings. It's got a reasonable dividend yield and it's got a reasonable balance sheet. And I think that there's some places in there where you can find value, and it may be value for a little while, which is sometimes the trick with value stocks, right? But if they can turn some of the things around, I think that they'll get out of the penalty box. And I think that that's the kind of recovery we're looking for.
Great. Sarah, thank you so much.
You're welcome.
That's it for this week. Thanks to Fidelity Investments for making the show possible, and a big thank you to NASDAQ for hosting us.